Oil prices just dropped fast. Is the Hormuz risk really over? What's actually driving this move? Give me 3 minutes and I'll break it down. First, the market had priced in the worst-case scenario, and now it's giving back that fear premium. The biggest concern was simple. If the Strait of Hormuz stayed disrupted, global energy supply would take an immediate hit. Around 1/5 of the world's oil moves through that route, so every escalation in the Middle East pushes traders to price and supply risk very quickly. But on June 24th and June 25th, the market got a different signal. Tanker traffic started to recover, transit conditions looked much better than they did at peak panic, and Brent crude fell back below $75 a barrel. That tells you traders no longer think the most extreme disruption is the base case. Second, the ceasefire and broader de-escalation changed the market's risk pricing. This drop in oil was not just about ships moving again, it was also about investors scaling back expectations of a bigger regional escalation. After June 24th, more money started moving away from the full disruption scenario, and global risk appetite improved. You could see it in airline stocks, in broader equity sentiment, and in the way energy prices started easing almost immediately. Oil reacts very quickly when the market believes geopolitical risk is cooling. Third, the market is now focusing on whether physical supply is really recovering. That matters more than dramatic headlines. A few days ago, traders were worried about blocked shipping lanes, rising insurance costs, and tankers refusing to move through the region. Now that vessels are moving again, expectations of a deeper supply squeeze have started to fade. That does not mean the Middle East is suddenly risk-free. It means the most important part of the story, actual oil flows, has not deteriorated the way the market feared. Fourth, oil prices are falling, but gasoline prices have not dropped nearly as fast, and that has created a new political angle. On June 24th, Trump said he had ordered an investigation into oil companies over possible price gouging or over failing to pass lower crude prices on to consumers fast enough. The backdrop is clear. Crude has dropped sharply, but U.S. gas prices have moved down more slowly. Public reports show the average U.S. gasoline price fell from $4.56 per gallon in May to $3.92, but that is still above last year's $3.22. So this story is no longer just about geopolitics. It is now also about inflation, consumer pain, and political pressure. Fifth, the market is breathing easier, but the warning lights are still on. Oil is falling because near-term risk has cooled. That is not the same as saying long-term uncertainty is gone. The Strait of Hormuz is still one of the most sensitive energy choke points in the world. If tensions rise again, or if shipping and insurance costs spike again, oil can rebound very quickly. Right now, the market is watching 3 signals: whether tanker traffic keeps recovering, whether the ceasefire holds, and whether lower crude prices start feeding through into gasoline prices and inflation. So the drop in oil comes down to 5 forces hitting at once. The fear premium is fading, ceasefire expectations improved, physical shipping resumed, supply concerns eased, and the market's attention shifted toward inflation and consumer prices. If traffic through Hormuz stays stable, oil could remain under pressure. If geopolitical risk returns, prices could turn back up very quickly. The key thing to watch now is not just where oil trades today, it is whether the world's most important energy corridor actually stays open and stable.